In general, with a single tenant triple net lease property, you're not really taking that direction, right? Because those properties essentially, let's say you start with a 20-year lease, the longer you own it, the less time you have on the lease. There's actually an increase in cap rate, which is not what you want as an investor, right? So single tenant triple net deals are typically reserved for people who are looking for generational wealth, who believe that the tenant is going to stay and continue to stay, and are looking for that stability, that security, that passive aspect.
Welcome to Spur Equity's Spur Your Wealth podcast, your ultimate guide to passive income through real estate investing. Join us as we together discover the secrets of building wealth one passive investment at a time.
From expert insights to inspiring success stories, this podcast will inspire you and empower you to take control of your family's financial future so you can live life on your own terms.
Hello, everyone, and welcome to another episode of Spur Equity's Spur Your Wealth podcast. We are your hosts today, Rav Singh and Budham Singh from Spur Equity. So on our podcast, we aim to bring successful investors and experts and thought leaders to our podcast to share their stories and secrets in investing so we can all stand to benefit from their experience. And so on today's episode, we have Dan Lewkowicz. Dan is a seasoned real estate veteran with over 15 years of experience in many facets of the real estate industry. He started his career house hacking. He quickly moved on to flipping houses in and around Metro Detroit, and eventually created a company called Renaissance Real Estate Ventures, which specializes in acquisitions, financing, renovations, and resale of single-family residential properties in the booming city of Detroit, Michigan. And so currently, Dan is a senior director of Encore Real Estate Investment Services, which specialize in shopping centers, medical office buildings, pharmacies, quick service restaurants, discount retail stores, and automotive repair part stores, as well as resorts. So a lot of valuable experience on both sides, both on the commercial as well as single family. So really going to enjoy the conversation today. Welcome, Dan. So happy to have you on the Spur Your Wealth podcast. Really looking forward to the conversation today.
Yeah, thank you both so much. I am as well. It's going to be a lot of fun, and I'm sure myself included, we'll all learn some things.
So Dan, you have, very much like Rav, you have this double life, as it were, with real estate, right? So you started on your own with some of the house flipping or house hacking. So and then also on the commercial side, you're doing a lot of big things on the brokerage side. So give us a little bit more, give our listeners a little bit more background as to how you got started in real estate, where your passion kind of grew from there, and just kind of tell us a little bit about your journey.
So, I mean, my journey, obviously it's unique in certain ways, but it's not unique in the general sense. I look at single family house flipping as like the gateway drug into real estate investing. And it is for a lot of people. So for me, the way that it started was, it was back in 2005. So now I got to change my bio, almost 20 years. And I was always involved in sales. That was always my niche. I always loved being a sales guy. So I had helped create a business called Disability Made Easy, which was it is a barrier-free home modification company. Started the company with some friends whose father had a terminal illness. And the whole purpose of the company was to renovate homes to make them handicap accessible for people with terminal illness or disability. So I did all the sales, but we had a project manager that worked for us full time. And I'll never forget, this to me was like the aha moment that got me into real estate. We're driving out to see a property. We get there, and the individual had been in an auto accident like 20 years prior. And the house was just 100% not set up for someone in a wheelchair. I couldn't believe my eyes. I walked outside. I said to the project manager, let's get back in the truck. Let's go back to the office. Like, let's give up, right? And he just kind of looked at me, didn't say anything, took out a pad of graph paper and a pencil. And in 90 seconds, he sketched a brand new front elevation, moving the doorway where one of the windows was, redid the layout of the property. And it just hit me that you could take something that was maybe a little bit or completely functionally obsolete, make some changes, and add tremendous value, right? That's one of my mottos, adding value. So to see that on a single family aspect was really cool. And what I did next was it was time for me to buy my first home. And I remember finding a house. It was ready to go. This was in the middle of the recession, but ready to go, move in ready. Everything was great. This will just kind of date this story, but that house was $175,000, right? 3 bedroom, 2 bath, nice starter home. Then I got wind that a couple streets over, there was a bank owned property that might be coming available. So I reached out to the lender. They expressed interest in selling it. I ended up buying that property for $81,000 cash. And I renovated every single stitch of the house. I didn't do it myself, but I hired out each of the trades. And I hung out at the property so I could learn about the renovation process. And again, same thing. I realized buy a house, add in some capital, make some changes. Now it's worth more than the sum of the parts. And that really kind of put me on my journey of flipping houses and flipping houses and flipping houses. And over the years, I probably have flipped close to 100 homes, which was a lot of fun, especially when I was younger and had more energy. But as things progressed, I recognized that there was this whole other side of the real estate business, and that was the commercial real estate side of the business. And I learned about commercial real estate brokerage, and I realized that I didn't have to spend my own capital. I didn't have to raise investor capital. I didn't have to borrow hard money. I didn't have to put up, that risk. I didn't have to, respond to the police in the middle of the night if a furnace was being stolen, right? And I transitioned into commercial real estate brokerage. I still was flipping houses, but as my time went on, I realized just how much more lucrative it was for me to function as a broker than as a house flipper.
Yeah. No, that's excellent. I was going to say, that sort of resonates kind of like my story at the same time, right? Where things happen sometimes at the right place at the right time. And so that's great that, you kind of transitioned from first, into residential, then into commercial. And so congrats on your success. So when you did start on the commercial side, were you starting on the commercial side as an investor or as a broker?
No, so that's an interesting point. I went 100% from being 100% investor, right, to 100% broker. So when I made that transition, it was interesting for me because, like I said, I could do all these things. I didn't have the cash out of pocket. I didn't have to borrow hard money. I didn't have to wake up in the middle of the night, and I could broker my deals. And quite frankly, the brokerage fees in the commercial real estate world are in most cases bigger and better than your average house flip profit. So I was able to go and kind of not only transverse from residential to commercial, but also from investor over to broker.
Right. And so is that something that you're currently doing today, or are you doing both investment and brokerage at the same time?
I mean, my bread and butter is definitely brokerage. I still do flip houses, not nearly as much as I used to, but if there's a great deal that I can't say no to,
Mhm.
I made a joke about it being a gateway drug, but it really is something that's it's hard for me not to go back to, right? But also something that I've been doing, and I think a lot of your listeners would appreciate this, is I've been a big in investing from most of my late childhood and adult life. So what I've been doing recently actually is utilizing my SEP IRA because I am self-employed. So I have a SEP IRA, and then taking that capital and investing in real estate deals. So for example, right now there's a deal. I have intimate knowledge about the deal because the person that's running the deal called me to vet the deal as from a brokerage perspective. It's actually a Starbucks build to suit in Ohio. And we have put together a loan, and I am funding that loan through my SEP IRA. So I then will pay $0 in taxes now. Granted, I'll have deferred taxes, later on if, when I pull that money, but it allows me to take that capital. And for me, I don't sleep well knowing that my money's in the stock market, especially like right now, but I sleep real well knowing that my money's in real estate deals. So that's something that I've become very passionate about and I'll continue to do as time goes on.
That's great. So, we've talked about house flipping quite a bit on our podcast, and Rav and I have had our individual forays in house flipping. I haven't done 100 homes like you, but I did venture into that arena. And I think, it takes a certain mindset, right? Like the thing with real estate is there's so many different ways to do investing in real estate that like not everyone will be well suited to your personality or whatever. For me, like for someone like you may have all the connections and all of the, the trades kind of lined up. For me, the first time I did it, it was, it was a struggle, right? Because like you said, I had to hang out at the house. I had to like see what was happening. because that's just the kind of mindset I had. But at the same time, I really didn't have a clue what the trades were doing, right? And so the more you do it, the more you learn from it. And I, it was a stressful time for me. But I know so many people, so many of my friends that are like, they love it. They love it every day, all day long, to the point where they're driving by properties or they're looking at stuff and they can do all of the math in their head, right? Like, oh, I can squeeze another 30 grand out of this or 50 grand out of this property or whatever. So I'm like, that's great. For someone else, that's awesome. And so now what I do is, if there are opportunities where there's a home flip or several home flips that are lucrative, I'm like, all right, let me partner with somebody that knows how to do it, and let's just bring the capital to the table and figure out what the returns look like. I would rather do that from a passive perspective than anything. So let's talk about because I think one of the things that we don't talk about very often on our podcast is because Rav and I are very much into commercial real estate, but we look at multifamily and self-storage and this income generating kind of value add, pushing rents, et cetera. But also operations, right? Like we're actually operating those businesses. Talk to us a little bit about the advantages and sort of the pros and cons, I guess, of what you've seen in sort of triple net. If you want to explain what triple net is, right? So the types of things that you just mentioned, like a Starbucks or a Verizon store or an AT&T store or something like that that's out there, Dollar Tree. A lot of people are doing investments in there, but what are the types of things that we can expect from a triple net lease? From a returns perspective, what are the risks involved versus risks, in operating those types of businesses and investing in them?
Sure. So as it pertains to your question of, what is a triple net lease property, the way that I like to describe what a net lease property is by describing what it's not and comparing it to another asset class that most people are familiar with. So most people are familiar with multifamily. And, if we want and again, these numbers are made up. I'm trying to make a simple analysis so that people can kind of see the difference. So let's take, for example, let's call it a 10 unit property. Let's say that, the property is bringing in $125,000 of annual gross collected rents, right? So that's $12,500, per unit, 10 units. And then on the other side, we'll have another type of property. We'll have a net lease property. This will be, and I'll define this in a minute, this will be an absolute triple net property. This is going to be a Wendy's property, but keep in mind, Wendy's is probably not the tenant. In some cases, there's a corporate guarantee, but in many cases, it's a franchisee that's guaranteeing the lease. But nonetheless, what the lease states is that Wendy's, the tenant, will pay you $125,000 annually to rent the building from you. Okay, so if we go back to the multifamily example, you've got $125,000 of gross collected rent, right? That's your top line income. However, there's tons of expenses, right? You're going to have things like property management. You're going to have things like insurance, taxes, repairs. You're going to have to cut the grass. You're going to have to shovel the snow. You're going to have to salt the walks. You're going to have to plow the parking lots. You're going to have vacancies. You're going to have capital expenditures when you have to put in a new roof, new HVAC, new plumbing, et cetera, et cetera. So at the end of the day, your expenses might be roughly half of your income. Now, if we flash back to the Wendy's property, $125,000 gross collected rent, just like the multifamily. But guess what? In this example, the tenant pays for your taxes. The tenant pays for your insurance. The tenant pays for all maintenance, any management. If there's a roof leak, they pay for it. If the parking lot needs to be redone or restriped or resealed, or if there's a window that breaks, they pay for it. So at the end of the day, you know exactly what you're collecting. Not only do you know exactly what you're collecting, but you know what you're going to collect in the future because the lease has built-in rental escalations. Those might be 10% every 5 years. They might be 2% every year. They might be 7.5% every 5 years, but you know exactly what you're going to make. So I have to step back a second because I did mention, I called this an absolute triple net deal. The reason I called it that is because all three ends are paid for by the tenant. Taxes and insurance are paid for by the tenant. Common area maintenance is paid for by the tenant. And roof structure and parking lot is paid for by the tenant. So that's an absolute triple net deal. That's like a cookie cutter, bread and butter, type of deal that I work with. We also have what's called a double net deal, which is exactly the same. However, the landlord is responsible for the roof, structure, and in some cases, the parking lot. So as it pertained to your other question, Bahram, which was, what are some of the advantages? Well, passivity, right? You can, especially with an absolute triple net deal, what you're collecting, and you don't have to do any type of maintenance, management, repair, none of that, right? It's like the opposite of house flipping. Now, in addition, there's stability and there's predictability. You know what you're going to be collecting for now for the next 20 years if it's a 20-year lease. You also have this guaranteed income stream, which, keep in mind, it's guaranteed by whoever signs on the lease. So in many cases, the guarantors of these leases have hundreds, if not thousands, of locations. So that's going to give you great security that even if they close your location, they're still going to continue to pay their rent and pay it on time. Now, as a downside, the biggest downside is you do not have diversified income, right? All of your income is coming from one tenant. Could that tenant go bankrupt? Absolutely. Rite Aid went bankrupt this year. Last year we had 3 franchisees of Burger King that totaled 382 units that they were operating. They were all 3 of them went bankrupt. So it does happen, and re-tenanting a property like that is time consuming and expensive. So that's a real risk. Now, one of the ways to get around that is one of the things I specialize in is shopping centers. So shopping centers have a diversified rent profile, right? You've got 5, 10, 15, 20, 50 tenants in the shopping center. If one leaves, okay, not such a big deal. You still got the majority of the income. We'll talk more about that, I'm sure, later.
Yeah, no, I love it. I think it's a great explanation. A lot of people understand rental income. They understand, buying a house, buying a duplex, buying a fourplex, right? And they know that, there's income coming in, but there's expenses going out, right? So love the fact that you kind of described what a triple net, a double net type lease is. It's very advantageous, right? And then, of course, people have to look at it based on the income that they're generating and the returns that they're getting, and so there's a correlation of risk versus reward and all that. So beautiful. I love that. So let's just take it a step further. So, understanding that you have a triple net lease that you're working on, and if it's either a single tenant or if it's multi-tenant, like a shopping center. So investors maybe think investor mentality. If I'm an investor and I'm looking to grow my net income, so then tomorrow when I sell this property, I'm going to make more than what I just paid for. What would my business plan look like? How are most investors, how are companies like funds that are out there, people who are raising capital, people who are basically doing their business plan where they know that they can grow their NOI. What does that business plan look like for an investor like me, or for my investors?
Yeah, great question, Rob. So in general, with a single tenant triple net lease property, you're not really taking that direction, right? Because those properties essentially, let's say you start with a 20-year lease, the longer you own it, the less time you have on the lease. There's actually an increase in cap rate, which is not what you want as an investor, right? So single tenant triple net deals are typically reserved for people who are looking for generational wealth, who believe that the tenant is going to stay and continue to stay, and are looking for that stability, that security, that passive aspect. Now, we can get into it here, if we want, but I typically see 3 major ways that investors can deploy a business plan to increase the value of their net lease property, and to do so in many cases in a massive sense. The first one is the vacant repositioning strategy, which is where you buy a property, right, for, call it $700,000, $800,000, $900,000. You might have to provide some TI, some tenant improvement dollars, to a prospective tenant who then does a build out, comes into the property. They're paying you $150,000 in rent, and the property's going to trade at, let's say, a 6 cap. And now you've built up massive amounts of equity and value just by taking these sticks and bricks and making them guaranteed by a large corporation. So that would be strategy number one. A lot of my clients do this, and they're super successful at it. The second strategy, this is actually a very it's not a very well-known strategy, and it's one of the ones that gets me the most excited. And I think you'll see why, because, as a recovering house flipper, right? I was so heavily involved in every aspect of the deal. Sometimes I was almost swinging the hammer, right? If somebody didn't show up. So I was able to build equity, right? By taking something, adding something to it, and the sum being greater than the parts. But at the end of the day, I expended a ton of energy. So this strategy does exactly the same thing with almost no effort. So this is called the blend and extend. And I have an example of the blend and extend that I helped a client deploy several years ago. So keep in mind, the cap rates are not going to be today's cap rates, but the principle is still the same. So this individual had a Walgreens pharmacy that they built 25 years ago. There were 14 months left on the lease. Very risky deal, right? Very high cap rate. At the time, what were they paying in rent? Walgreens was paying, let me just see. I believe that they were paying at the time, $285,000 in rent. Okay. And which is, by the way, relative, it's mid to low rent for a pharmacy, but 285 in rent. The property at the time was around a 9 cap. So it was worth about 3.16 million. So let's remember that number, 3.16 million. Again, 285,000 in rent, 14 months, very high left on the lease, very high risk, therefore 9 cap because it's a risky deal. 3.16 million, 3.16 million. So I told my client, I said, we're not selling your property. He's like, what do you mean? I want to sell it. Let's get rid of it. I said, no, you're going to go to Walgreens and you're going to ask them for a new 10-year lease. And they're going to come back to you and they're going to say, they might say yes, they might say no. They're going to ask you for a rent reduction. So I said, go see what happens. Makes that phone call, has that meeting. He comes back to me, goes, Dan, I got good news and bad news. I said, what is it? He said, good news, new 10-year deal. I said, that's great. He said, and I said, in the bad news, he said, bad news, they're asking me for a $60,000 haircut. Are you crazy? Like, why would I do this? This doesn't make any sense. I said, hold on a second, Mr. Client. Take your new rent, $225,000. Today, with a new 10-year lease, that deal is going to trade at a 5.85 cap. That's $3.846 million. What was my number before? I've got 3.846 million, and before I had 3.16 million. Was that right? So this guy did his, blend and extend, which to me is like, a house flip. And just by a signature on one piece of paper, the property went up in value by $686,000. So that's why I love that strategy, because it's so passive and it adds so much value. So there's one more strategy. I don't know if you guys wanted to talk about this one first, or if I should just throw out the third strategy.
Let me just kind of get into this. So I love this idea, right? This first one is very self-explanatory. You have something that's gone dark. I end up coming and I'm buying it, and I'm bringing in a tenant by the help of a broker who specializes in that. And now all of a sudden I created value. Get that? I think that's great. That's something that makes total sense. The second option that you gave us in terms of the blend and extend
from a
also
seller
makes
perspective
sense, but
yeah,
from a seller perspective.
As a buyer,
so my question was, does it make sense
Yeah.
if I'm the investor and I'm the buyer, or what makes sense for me with the blend and extend strategy if I'm a buyer looking to buy this property, knowing that I could do that, but I'm taking a big risk? What if they say no?
Great question. Great. We'll flip it the other way, right? From the buyer side. So great question. So what happens in those instances is the buyers, with the help of a broker who has relationships with the tenants, will hunt for short-term deals. These pharmacy deals that have sub 2 years, for example, left on the lease. And then we will reach out to the tenant with the buyer and say, hey, how's the store doing? What are the sales like? Do you guys want to stay? And then what can happen is you can actually do this blend and extend during due diligence. So a lot of times these investors will put the property under contract, 1.5 2 years left. They know there's a good chance they can execute the blend and extend. Otherwise, they're not going to waste their time. And then during due diligence, they go ahead and do the blend and extend. By the time they close, by the way, they can either close on the property and have that massive equity buildup, or oftentimes they will then assign the property to a new buyer so that they can take that delta.
Yeah, I got it. So that makes sense. And is the new buyer, or not the new buyer, but is that investor, basically they're taking a 50% chance. They're saying, okay, well, let me put it under contract. Now I'm buying at a 9 cap or whatever that, high cap is. And I'm going to go with your help and I'm going to go talk to the tenant. The tenant could say yes or could say no. If they say no, I can cancel the contract. I'm still in my due diligence time period at that time, right? I may lose a little money and this and that, but that's cost of doing business. But is that what you were talking about?
Yeah, and in an example like that, I mean, there's really a very limited cost because to go talk to a tenant doesn't cost anything. If it's an absolute triple net deal, they might not even do an inspection until they know they're going to get the blended extension.
Right. Okay,
and
that makes perfect sense.
I would say, like, that due diligence, it really depends on how vetted or invested the tenant is into that location as well, right? So you got to look at the background, you got to look at the guarantees, you got to look at the corporation behind it, and what their cost of moving locations would be versus sticking around where they are, right? So even though there's 14 months left on it, you could probably assign a probability of, hey, we could probably get a negotiation with a new 10-year lease in relatively easily versus like it might be an uphill battle, right?
Yeah, absolutely. And I mean, another variable that's very important is the sales at the location, and the rent, right? If Walgreens is paying $450,000 in rent, they might want to trim that. If they're paying $200,000, maybe they don't need such a big discount in their rent. But if their sales are, and there's all the numbers are all, we look at things in specific lenses. But if they're high sales relative to the other stores in the corporation, greater chance they're not going to leave.
Correct. That's very, very good. And what about number 3? You had third strategy.
Yep. So this one's great. So this is so we had the vacant property reposition, right? We had the blend and extend, which we've talked a lot about. This one is going to be essentially just the multi-tenant retail shopping center play. Okay. There's a ton, and I mean a ton of shopping centers all over the country that provide this exact opportunity. And I'll explain. So you have a shopping center, let's just call it 10 tenants to keep it easy. And, some, or maybe even all of them, are actually not on triple net leases. They're on gross leases. I've got a shopping center right now that I'm selling, closing in a couple weeks, and every lease is a gross lease. So what that means is it's more like your multifamily deal, right? In this deal, the gross collected rent is $98,000, and then there's $37,000 in expenses, but those expenses could be variable. Cost of gasoline goes up, cost of salt goes up. That means your cost of plowing goes up, cost of insurance goes up. That'll mess up your income, right? So what this aspect of the multi-tenant retail redevelopment play, if you will, has many facets to it. So the first facet is going to be at any lease rollover or anytime you sign a new lease with a new tenant, you're going to convert the leases to triple net leases. Okay. And by the way, there's a lot of different types of triple net leases in shopping centers, but essentially, let me explain to you what it means. So let's say the tenant, for round number purposes, is paying you $100,000 in rent. Okay. And they represent 14% of your GLA, your gross leasable area. Your lease might say that whatever the expenses are, they have to pay 14% of them. Okay. So, and your expenses might be snow plowing and parking lot and maybe even roof. I mean, that not typically, but maybe even roof, maybe cutting the grass. Maybe they even reimburse you for the management fee. So the leases, in multi-tenant retail and shopping centers, there's a lot of variability. But the first one would be to convert them from the situation where the landlord has to pay the expenses and the landlord has to deal with any changes in expenses or what have you, to triple net, where the tenant actually reimburses. And I recommend to all my clients that you don't have any ceiling on that. Like if the tenant is reimbursing you, don't say it's up to $3.50 a square foot. Make sure that can be reconcilable every year. And if your taxes go up or your insurance goes up or whatever, that you're not coming out of pocket. So that's the first way that we're going to optimize this asset. The second way is we're going to get better tenants, right? If there's bad tenants, we're going to evict them. Then if they're not paying, you can legally evict. If there's a rollover, a new tenant is coming in, we're going to bring them up to market rents. If there's, if it's the end of the options periods for a tenant, we're going to bring them up to market rent. Because keep in mind, a lot of these shopping centers are what I call mom and pop owned. And over the years, a lot of these mom and pops, they didn't really care. They had this shopping center. It was paying for their life. It was paying for their kids' college tuition. Did they really want to go to the tenant and ask for them to pay more rent? No, they didn't. Just like some multifamily is like that. So raise those rents. Now, another thing that you can do is decrease your expenses. And that way, if your lease is written in a sense that you get a certain amount reimbursed by the tenant and you don't have to give them back any overage, that's another way to put some money in your pocket. Obviously, deploying some capital expenditures, making the shopping center look nicer, getting better tenants. Now we've really increased the NOI, right? We've increased the rents. We've decreased the expenses or passed those through to the tenants. And we've lowered the cap rate by putting in better tenants and by having longer leases, by having a nicer looking center. Lower cap rate, higher NOI equals massive value increase for the owner.
Absolutely. I think you kind of hit all the major points in regards to from an investment angle, what we need to look for as an investor, right? What are the three buckets, three positionings that you kind of talked about? So for me, if I'm an investor, then it makes sense to me, right? But what is not making sense to me in today's market is maybe debt. So let's kind of bring in the debt component to it. How are you underwriting, or how are some of your investors underwriting debt? How does it make sense to buy a shopping center at a 6.5 cap with a 7% loan or higher?
Yeah, and I'm sure you saw the massive sigh that I took as soon as you started talking about this, because as a broker, I want the spread between interest rates and cap rates to be as high as possible, just like investors do, because that's really the one metric that drives market velocity. I'm very thankful. I've had even the last few years have been great. I've been very, very busy. But in general, if you look at the brokerage world in general, we're dealing on the single tenant net lease side almost all, maybe 90%, 85% of the single tenant net lease deals we're trading sub 6 cap, right? Which at 3% debt, great, sign me up, right? But when debt started getting to 6.5, 6.75, 7, 7.25, that whole market became only a cash market, which, by the way, about 24 months ago, I really pivoted and started focusing more on vacant repositioning assets like we talked about, as well as shopping centers. And the reason I pivoted more towards shopping centers is that shopping centers in general traded a higher cap rate. I saw that interest rates were going up. So I had a feeling that capital would fly more towards the shopping centers because you would have that spread, right? I'm selling a deal right now, the one I referenced, small deal, 9 cap, right? And the borrower is getting debt at 7%. Okay, 200 basis points. That's decent. So that's, I think, one of the ways that investors are handling this storm is they're flocking to either redevelopment opportunities, right, which are cash deals but have opportunity for massive upside. They're also flocking to shopping centers. We're seeing a lot more buyers that are interested in shopping centers because they're still financeable. And we are seeing other investors. I don't know that I necessarily agree with the strategy, but they're basically saying, like, stay alive till 25. Let's buy some properties. We can always refinance in a few years. I like to look at things and evaluate what is their value today. I don't believe in that, but some people are doing that. So, I think that people are, modifying their strategies. And, I'm very eager to see the Fed start to cut rates a few times. I think that's going to put, the market is still strong. The market still has pent up demand. Once you put that catalyst in there, I really believe that we're going to be in a very solid.
I agree. I mean, just a couple of comments before I give it to Param. So I'm seeing exactly the same thing in regards to what the buyer's mentality is. There's a lot of people out there, a lot of cash out there. Maybe some of that cash is sitting on the sidelines. I have people who call me. So, as a hotel broker, I mean, my bread and butter is I buy and sell hotels for my clients. But from time to time, I have investors who've bought some of these properties. They'll come to us and say, hey, buy us something for our families. Buy us something, let's say, like a small meaning 10 to 20,000 square feet shopping center that I can purchase. And so there's a lot of those buyers that are coming to the table. And these buyers are not necessarily flippers. They're not raising capital and, buying it for 3-5 years, exiting. That's not their business plan. Their plan is to buy these properties and, generational, right? And keep it for their children and do whatever they need to do. So for them, they're coming to me and say, look, Rav, I understand that there's that gap, right? Your cap rate might be 6% and debt might be 7 or whatever that might be in terms of the being upside down. But for them, they're putting 50% down, they're going to the bank, and they're getting the leverage. And so for them, they just want to survive, right? They want to buy this property, they want to survive for the next few years. As long as they're breaking even or making just a little bit money, that's what it is. So they're basically coming to me and saying, find me a trophy property, find me something that's really good and a path of growth that I want to stay, and don't worry about rest, because it's not something where I need to pay dividends or distributions to my clients. It's for my kid, it's for my family. I want to keep it. And so that's the buyer I understand. That's the buyer who's motivated. They're maybe looking for something. And then the second thing that I want to say is that I also have people who are coming in and saying, look, find me a big investment property. And so what they're doing is they're forcing value by now saying, look, if I'm buying that property, maybe it's an older property, but it has a big parking lot. What if I can take part of that parking lot, carve it out, and bring in maybe a tenant or bring in a developer who wants to put something else on it? So forcing that appreciation, maybe either selling that corner out or putting developing that corner, putting something else on it. Now I can enjoy some more rental income that's coming in, so their NOI hopefully goes up. So there's a lot of ways of doing it. So I really appreciate you mentioning the three different ways. And I bet in today's market, some of the tenants are probably going dark. And so you started focusing on it the next, maybe like last 2-3 years ago. So, good for you. Hopefully you're getting some of these investors who are thinking outside the box, thinking, hey, look, if I can buy something at a high cap today, that's guaranteed that, a bigger tenant is already paying my debt. And how can now I reposition this, bring in a tenant, maybe at a higher dollar, rate, and then either flip it or sell it or do whatever I need to do. And that arbitrage in the middle is how they are making money.
Yeah, exactly.
No, this is great. So a lot of great things that I've heard in this conversation. And Dan, you did a fantastic job of just really simplifying this world. And, not only for, folks that may, have been in it for a little bit, but even for someone completely new, I can see ideas generating. And that's what this podcast is all about, is that, hey, there's so many different ways to kind of skin the cat of real estate investing. And so really laying out those specific strategies. And I think not only those strategies, but how those strategies can make sense in today's market, which I think everybody's struggling with right now, whether it's single family, whether it's commercial, everyone's trying to figure out how to make it work in today's economic environment. So I really appreciate you going through that. Just piggybacking off of Rav's point, and I know we're running out of time here, but I think one of the things that folks really understand well in the triple net, folks that operate in this space, and you had alluded to it earlier, is that generational wealth type of investor, someone who understands that this is it's not a quick home flip, it's not a 3-year kind of appreciation value add play, but it could be, right? There's opportunities like that, but really it's looking at a way to park capital in a very, very predictable model. It's a different risk profile. And I think that's the key thing that I got out of the conversation, that we all need to understand what our risk profile is. And we have some investors that have different risk profile for different dollars that they invest, right? So they'll do high risk investment, a certain percentage, medium risk, and a low risk. And so this can fit within an individual's or a family's investment portfolio really well, especially in today's world. If you are looking at things where you're like, I'm used to higher returns and this value add stuff, but right now is not the right time to invest. Well, there's an opportunity for us to park some money into very predictable asset that can, have, steady growth over the next few years until you're ready to, go back into some of the things that you do on a more heavier level once the economic climate comes back to where it's doable. So I think that's something that I took away from the conversation, just kind of summarizing some of the things, some of the themes that we've discussed. Anything? So as we wrap up, Dan, again, I really appreciate you simplifying it. I think you use some great language to really be able to do that in a podcast, a short podcast setting. So I really appreciate that. But any final words of wisdom for our investors? Anything that you want to share with them, and what gets you excited about 2024, 2025? What are some of the areas that you're personally excited to look at, and what our listeners should be looking at, some cues as to how to navigate the coming waters.
Yeah, I mean, my perspective of the last 5 years in real estate have been like, kind of just a massive pivot, almost like step on one tile and then that tile's fallen, step on the next. And I think it's going to be like that for a little while, but I think that people shouldn't be discouraged because that means there's tremendous opportunity. So I think that investors today need to have their eyes open more than ever to opportunity and to thinking outside the box. You might, for the last 15, 20, 30, 40 years, have been investing a specific way, and that may or may not work today. But there's other opportunities that do work. So, I think that in my outlook, I'm pretty optimistic, cautiously optimistic, but pretty optimistic. I think that, from my perspective, I've noticed the last 6 or 7 weeks that our deal volume is up, number of LOIs are up, number of contracts are up, closings are up, listings are up. I can't pinpoint what's changed in the last 6 or 7 weeks, but something has, right? So I think that overall we're doing very well. And I think the market is very strong. It's there's a single lever that can put the most velocity or the most downward pressure on the market. And that's simply interest rates. That lever was pulled harder than it's been pulled since I've been alive, probably I'm 40. So probably the last 40 years, and the market's still going. So I believe that as the rates will start to be decreased towards the end of this year, as we approach this election, I think that that's going to just put a lot of fuel on the fire. And, the market right now it's moving, it's dynamic, it's shifting, it's changing. It always is. But right now it's really churning. And I think as an investor, if you own property, you got to reach out to an expert like myself so that I can tell you what it's worth. If you want to sell property, same exact thing. If you're looking to buy, I mean, especially in the net lease space, look at as many deals as you can, right? It's like I tell people when I go to buy a house for myself, first house I look at, I want to sign the contract. I love it, right? But then I look at another house. I say, oh man, that one's got an attached garage. I want that. I go to another house. I see this one's got a finished basement. Same thing with real estate. You will become a better underwriter in whatever niche you specialize in, the more repetitions that you make. It's just like anything. So make those repetitions, reach out to people like me. I make myself very accessible. I love helping people. If you've got a deal, even if it's not mine, but you want an extra set of eyes on it, please by all means reach out. And if there's anything I can do to add value, that's why I'm here.
That's great, Dan. I appreciate that. So if our listeners want to reach out to you directly, what's the best way to get in touch with you?
So first of all, I'm on LinkedIn all the time. I put out daily content. My first name is Dan, last name Lewkowicz, Lewkowicz. Again, Lewkowicz. You can always reach out that way. I always love when people tell me, hey, I heard you, on this podcast or that podcast. Additionally, I will, if you want to talk about real estate, if you're getting into the industry, if you have property, you want to know what it's worth, you want to sell your property, I'll give you my direct cell phone. You can reach out. I would love to talk. It's 248-943-2838. Again, 248-943-2838.
Awesome. Thank you, Dan. You guys heard it first. So when you say, hey, Dan, I heard you on the Spur Your Equity podcast, he's going to give you the real deals, the super
That's right.
secret exclusive deals. So make sure you mention our podcast when you reach out to him. Well, that's great, man. Dan, I really want to thank you. I learned a lot today, and I know there was a plethora of guidance in all of your content that you shared with us today. So I encourage everyone that was listening, re-listen to this podcast again and again, because there are some tidbits that you're going to miss, as you're listening to it the first time around. So definitely go back and listen to it, because there are some very, very key strategies that Dan shared with us today that I think is going to help anyone that's looking into deals, especially in the commercial space, in the net lease space. So, but that's all the time that we have for today. Dan, I'd love to get you on back on the podcast in the future for sure. But thank you so much for sharing your time and your story, and really all the guidance. I think there's so much wisdom in what you shared today, and I think a lot of our listeners are going to benefit from that. So really, thank you for sharing that.
Absolutely, my pleasure. Thank you for having me.
Awesome. And for all of our listeners, thank you for tuning in to this episode of Spur Equity's Spur Your Wealth podcast. Again, we are Param Singh and Rav Singh from Spur Equity. Remember, your journey to financial freedom begins with both knowledge and action, where knowledge is power,
but action is superpower. So until next time, happy investing. Thank you for joining us on this episode of Spur Your Wealth podcast. We hope you enjoyed the valuable insights and inspiration. Don't forget to subscribe to our podcast and stay updated on future episodes filled with actionable tips and strategies.
If you want more information about our investment projects, visit us at SpurEquity.com. If you have an inspiring story to share and would like to be a guest on our podcast, email us at podcast@SpurEquity.com. Until next time, happy investing.